Firstly, what's your view on the trade market setup?
Good morning.
Good morning. Are you seeing any kind of worry because the market seems to be a little nervous? Overall, what's your view on the trade setup currently?
We believe that in the immediate short-term market is in a consolidation phase. We have seen very less volatility in the entire calendar year of 2017. We are of the opinion that volatility is going to increase in 2018, and also the return expectations have to be more moderate than 2017 for this year, for the next 12 months. So with that in mind, we believe the immediate short term could be a consolidation phase. Nothing to worry from a long term investor perspective, but if somebody is unable to take this volatility, obviously there is a problem. Last year everyone felt that equities are one-way street where volatility is less and you can make money entering at any level, and that couldn't have lasted longer, and now we are in a phase of consolidation clearly.
Harsha, good morning. Neeraj here. When we talk about the extreme short term, would it be dependent on the results, and are you talking about the next 1 or 2 months, or could the volatility persist for slightly longer than that, maybe a couple of quarters?
A couple of months definitely until the earnings season. I think that will give us some sort of an indication, although I won't say that it will give full indication in terms of how next year is going to pan out, because there are many ifs and buts that are going to be there post June quarter, because until June quarter we have a lower base that was there because of demonetization and GST transition last year. That's going to go away, and then post that we are going to see some of the provisioning numbers increasing on the corporate lenders in the banking space. So clearly FY19 earnings numbers, you won't get any confidence by looking at let's say March quarter numbers this year or June quarter numbers next year. So to that extent earnings alone will not really help the markets. But yes, I think as we move into the second half, the news flow would be more from a political setup. I think that's what is going to drive the sentiments then. But until then, I think it's going to be the earnings trajectory that will drive the markets.
How would quarter 4 shape up, Harsha? I mean, one is, the commentary in the last few weeks has shifted to what kind of an impact would distraught banking sector have on Q4 earnings. We did a bit of a study as to what this PSU bank washout or the recent cuts in the earnings for some of these corporate facing banks come PSU banks could do to the Nifty EPS. It didn't seem to be too much based on at least what the Bloomberg terminal is throwing up. Are you bracing yourself for some unpleasant news on the earnings front because of banking? Or do you think it will be muted, but there's just too much of conversation happening around it?
See, it's at this point of time very, very difficult to predict the kind of provisioning that will be required in the fourth quarter. There could be some upfronting that some of the banks would do since they know that 6 months down the line anyways more of this has to happen. There may be some delays also in some cases, so we really don't know how some of these earnings numbers will pan out for the PSU banking space especially. So apart from that, I think rest of the market we don't think there will be too many disappointments. The disappointing sectors are known. For example, telecom is going to disappoint in terms of earnings, pharma is going to disappoint, PSU banks. So these are the pockets where we have no clarity in terms of how much will be that drag on the overall earnings. But rest of the markets we are fairly confident that will grow at mid-teens. So overall numbers would depend largely in terms of how this drag is going to pan out. If the drag is more than what everyone is expecting, then we are going to have very muted set of numbers. Otherwise, I think it will be somewhat similar to the previous 2 quarters.
Harsha, what's your view on metals? Overall, metals have corrected significantly globally. How does this sector pan out now?
See, we were of the opinion that the valuations had run up much ahead of fundamentals in the entire 2017 for metals pack. Now that has corrected quite significantly. And also global growth seems to be catching momentum, and there are positive expectations in terms of how the global growth is going to pan out over the next 12 months, 24 months. So given that, we think that at these valuations there is some merit in looking at metals companies, but one will have to be stock specific, looking looking at what could be the possible impact in terms of the likely tariff wars that are going to come out, and also in terms of how that is going to displace some of the regional capacities and supplies. That is what we need to see and take stock specific investment opportunities.
What about the oil companies? Crude again back at $70. How will that play out for the oil marketing companies?
We continue to hold some OMCs in our portfolios. As of now, there has been market determined pricing. There has been no interference in terms of not adjusting the prices to market reality. So as long as that continues, I think even if the crude were to move up to higher levels, the profitability will be maintained, and we won't be really worried about that segment as of now. But in case there is a change in any of the mechanism in terms of adjusting the prices on a regular basis happens, then we'll have to wait and see how that is going to impact profitability. But in the last 4 years or so, we haven't really seen that kind of an impact. But as we are getting into an election year, some things could change. That is what we need to see. Other than that, I think oil marketing companies continue to be attractive on the valuation basis.
Okay, just hold on, Harsha. Let's pull up Hindustan Construction Company. That's down almost 4% and close to 20% fall in the recent times. And a DNA article that's come out has indicated that Lavasa, which is owned by HCC, is headed for bankruptcy and probably will approach the NCLT. So I think they don't have money to even finish the project. So Neeraj, another one goes down.
Yeah, and this was the only shot in the arm for HCC, right? I mean, they had gotten that arbitration awards, and all of that was anyways done, but they still needed this to work for them to come out of the woods. Somehow, this is not good news for HCC at all.
It isn't.
Yeah, well, let's wait and watch. Could have some impact, further impact though. As Darshan said, if you just look at the 1 month chart, you will see that HCC has, unless I'm very wrong, come off quite a bit from those levels as well. Maybe the recent corrections are at the tune of 15-20%, yeah, 70% over the last 1 month. So some of it was being priced in as well. I mean, things come out, and let's wait and watch if indeed there is an approach done to NCLT as well. That whole process, Harsha, is becoming fairly interesting. It's difficult to predict who the winners of this would be, because I think it will eventually depend upon a Supreme Court decision as to who gets awarded what. But how does this augur for what happens to the metal space after some of these assets which were operational but not operating at full capacity come into stronger hands, and then there is by natural augmentation an increase in capacity that comes in for India's steel sector? What does it do to this space, which was clearly the biggest or one of the biggest outperformers over the last 12 to 18 odd months?
See, as far as some of these capacities which are under NCLT today, they are running simply because they need more cash flows to service their interest burden. So to that extent, I think they are not looking at earning anything over and above debt servicing. And once the resolution happens, I think there will be more economic sense that will prevail. That's what our belief is. And hence, you will not see too much of readjustments in terms of demand supply, but from a pricing perspective, I think it will be a lot more sensible is what we believe. And if that were to pan out, I think there is no risk for any of the metal stocks per se. But as you feared, if the buyer starts to ramp it up in terms of more capacity additions or sweating it out much more than what they were doing earlier, then obviously that could have an impact on prices in the short term.
But you don't believe that hypothetically, if an ArcelorMittal, though they've been out of bid now, but if an ArcelorMittal were to come in, or JSW picks up SR, Tata Steel gets a Bhushan, and they start operating these capacities at a much higher capacity utilization levels, wouldn't that increase the supply and therefore a bit of a compromise on prices over the medium term? That's not a worry?
Without getting into individual cases
Sure, of
and
course.
individual
Yeah.
companies, I think whoever is going to be a part of this entire process, they are already present in those sectors in the country or in the region. So to that extent, anyways, they have an vested interest to keep everything at a balance. I don't think there will be indiscriminate ramp up of capacities and prices coming down. We don't visualize that at all.
Okay, Harsha, yesterday, or rather this morning, we did a small study of, despite the market fall, companies which would be trading at premiums to their 5-year average valuation multiples, PE, price to adjusted book or thereabouts. There's a fair bit of Nifty presence, which is still trading at premiums and a substantial premiums to their long-term averages as well. Is that something that could concern people as well, or investors as well? Does it concern you as well, that we have had a fall, but there is room for a bunch of these companies to fall too, if need be, without being considered cheap?
Yes, that is possible, because when you look at overall valuations of Nifty today, they're about 10 to 15% higher than the long-term averages. So to that extent, there are pockets within Nifty as well, apart from mid caps and small caps, which anyways have been very, very expensive relative to large caps. But even within the large cap space, there are companies and sectors which may have been trading at higher valuations than in the past. So those are the spaces where you need to be more watchful. If earnings start to disappoint in some of those pockets, I think there is room for further fall. But at this point of time, some of these names are some of the pockets where earnings growth seems to be better than the rest of the market. So to that extent, there is no fear of correction in these names. But we'll have to wait and see in terms of how earnings are going to pan out.
Yeah, okay. So, Harsha, with an assumption that, actually, let me ask you that question first. How was March? A lot of people were talking about, in fact, some of your peers came in and said that in certain dividend-paying schemes, they have booked profits or booked some money in order to pay off the dividends as well. In certain cases, it's been high, but nothing quite unnatural. But my question to you is, how was March for Kotak AMC in terms of, one, the fund flows, and two, whether you did book profits into certain schemes if you needed to, or if you thought the valuations were expensive, and where is it that you're deploying fresh money or putting fresh money to work?
See, profit booking is a regular process for us. We don't wait for any event or any quarter end or year end to book our profits. So that's a normal ongoing exercise. And when we believe that relatively a particular stock is expensive and we need to book profits, we book profits and move into other stocks. And clearly over the last couple of months, we haven't added new names into our portfolio. Wherever we have been a little worried in terms of valuations from those stocks, we have booked profits and got into something we were already holding and which have fallen without any change in fundamentals. So that's been broadly our stance, not adding new names, not adding more risk to the portfolio. As far as the fund flow is concerned, we haven't seen much of a difference in terms of the trend that we were seeing even before March. I think the real sense of flows will come only in the month of April and thereon, because this month, as you rightly pointed out, there are dividend declarations. There will be some profit booking or selling because of taxation change, etc. So we really don't know whether to take March numbers as a barometer for what's going to happen over the next 12 months or so. Having said that, I would also like to add that we haven't seen any impact on any kind of flows in the SIP market. That number is more than $1 billion a month. Even EPFO flows into ETF should continue at current levels. So large part of the flows that we have been seeing over the last 1 year will remain intact irrespective of market valuations, is what we think. But the exact sense in terms of how the numbers are going to pan out, I think April onwards we'll get a fair idea.
What about, Harsha, if you can humor me, what about the discretionary side of the flows coming in? SIPs, I'm happy, really happy, and that's the effort that that we have on the mutual fund show as well, is order to get people to stick to their investments during the bad times, because that's when you will make money. But what about the lump sum flows? Are they in these months of February and March, wherein we've seen the first signs of real volatility coming in, have they changed a bit?
Yeah, in the month of February, we saw some moderation, but I really don't know whether it's the beginning of a new trend in terms of lump sum investments. The net retention in the industry was lower compared to previous few months. But we also had 3 less working days in the month of February, so that itself is a 10% fall. So I really don't know whether to take that as an indication in terms of how things are going to pan out going forward. March, again, as we discussed, it's not a normal month because there are inflows and outflows due to some of the dividend declarations that have been there in the industry. I think, I'll again repeat that we will get a fair sense of discretionary flows only from April onwards.
Okay. One last question, Harsha. One side of the market discussion would be to think of where do people put in money, where do investors or where do fund managers like you park your money. The second part is where is it that you completely avoiding any kind of investments based on the news that we have and the valuation picture that we have at hand. What do you want to talk about that?
As I said, we are focusing more in terms of visibility of earnings growth going forward. So there are pockets where we can't be really confident in terms of future earnings trajectory. So those are the names or the sectors where we have been very, very circumspect or have been avoiding the spaces. For example, we hardly have any weight in telecom sector. On the PSU banking segment, we hardly have any weight. So these are the pockets which we believe are going to be under pressure in terms of profitability. Pharma again is another segment where I think a lot of the fortunes of the sector is dependent on US FDA approvals, where you can't really predict either the timing or the outcome of those approvals. So again, we are not in the camp to take any blind bets in that segment. So these are some of the pockets where we are avoiding. Apart from this, we are also a little cautious on the NBFC sector, where we believe we have seen significant growth in the business in the past, and interest rates were very, very conducive for wholesale borrowers. And as we move forward, I think there is going to be pressure in terms of cost of funds, and also with the kind of growth that we have seen in the recent past, there could be asset quality issues coming up in the NBFC sector as well at some point of time in the future. As of now, there is no risk, but I think given the kind of growth that we have seen in the past, one needs to be a little cautious, especially at these valuations where some of them have been trading even higher than some of the private sector retail banks. So these are the spaces where we have been cautious. Otherwise, by and large, we continue to hold the same view on the markets, that there is economic recovery which is visible, although the pace could have been higher than what we have witnessed, but at least it's visible. And there is a large amount of excess capacity in the country, and the operating leverage of this is going to pan out over the next 12 to 24 months, and that's what will provide profitability boost for Indian corporates, and those are the bets that we are taking in our portfolios as well.